Gold is in an uptrend. Gold had a little push up right up into resistance, and then some selling came in. Now there is actually a bigger reason why. There's two reasons why there's selling that hit the market. First of all, gold pulled into resistance, and there's naturally going to be sellers up there. But the main core reason, and this is our partner Brian Benson, who runs our options service, shared this as well on Friday, saying, listen, the CME, the Chicago Mercantile Exchange, raised the margin requirements for silver. And that's what happens when something becomes volatile and moves fast in the futures market, and everybody starts chasing it. I want to cover the really big picture stuff very quickly because it all bleeds over. Then I really want to focus on what's going on in the precious metal space and then kind of carry over to the overall stock market as a whole. So there's a lot going on here. I will have a little clip also of my son and I doing a little bit of skiing this weekend and some fresh powder and go from there. But let's jump into the charts. So let's go into the big analysis really quickly here. I know you've seen this probably 1,000 times from me, but I do believe we are in this stage 3 topping phase, and after that becomes a big financial reset. So just knowing we're somewhere in this topping cycle, we got to be very aware of things. Now, when we come down to market participants, their emotions, we are kind of in this euphoric complacency phase. I mean, we live and breathe the markets if you're watching this, so we're not the general public so much. We understand kind of what's going on. We might not be that complacent. We're worried about a market decline, and we've got a strategy in place so that when it does happen, we not only avoid it, but we benefit from it. But the general public think the markets are still going up and the markets are going to keep going up and things are okay. But the problem is we are in a bit of a euphoric phase. We're in this late stage, which if we come down to these cycles, this is the most important kind of where we are in the markets, because this is where things start to twist and tweak a little bit and you don't get the performance you think in certain things. There's a weird timing to stuff. So right now, as the stock market is starting to getting closer and closer every week, more or less, or month, to a major market top, we are seeing these specific sectors lead the way. We've got industrial capital goods. Let's just take a look. Now, industrial capital goods are factories, companies thinking businesses are super strong. They're going to have another strong growth after this little pause or this little slowdown, but they don't realize the music's going to come to an end and their business is going to slow down. So industrial capital good companies have been doing very well. We're trading up at all-time highs other than a quick pullback there on Friday. We hit all-time highs and pulled back a little bit. There was some broad market selling going on in the market. So this sector is showing us that businesses in that are very bullish. They're overly bullish in expanding their corporations, their equipment. Now, if we take a look, obviously, let's take a look at energy. Typically, we see energy stocks perform very well just before the music comes to an end. Let's take a look at XLE, the overall energy service space. It is trading near all-time highs. It's same time frame after COVID, trading up here as a strong defensive play. Now, I believe there's going to be amazing opportunity when this breaks to the downside, but overall, we definitely don't want to fight this trend, and energy stocks are performing very well. Now, the last one, as we all know, is precious metals, and this is where things get really exciting and also tell us how close we are generally to a major stock market top and also a peak probably in precious metals. So, because I'm going to touch on my targets for silver, my targets for gold, a few different targets for each, why we saw silver and gold sell off so much on Friday, all of that stuff here. But right now we're in this precious metal space where precious metals are on fire. They're outperforming, they're moving up with the stock market and doing very well. So what I want to show you is the little bit of the nuance going on in the precious metals space. Now, gold was doing exceptionally well for the last couple of years. Now everybody has kind of pivoted. There was a strong move into miners, and now we've got the strong move moving into silver. So this is the silver monthly chart, and it is ripping to the upside. Now, this is where things get really interesting. If we take a look at gold underneath on the monthly chart, gold has been trading sideways where silver has been pushing higher. And this is because gold was the kind of the strong play, the overall tide. People were long gold, and then suddenly it became the crowded play, and everybody started to move into miners, and they want to get into silver to generate more returns, which there's nothing wrong with that. It's just the way human psychology works. Is when you know the trade's working, how do you leverage it, right? Silver is a way to do that. And so silver is breaking out and leading the way. Well, gold has actually still been trading sideways for the last 3 monthly bars here. from the peak that it had in here.
As markets approach critical turning points, leadership narrows. Capital flows aggressively into industrial capital goods and energy, sectors that thrive late in economic expansions. Businesses expand, invest, and assume growth will persist, often just as conditions are about to change. Energy stocks, in particular, tend to act as both inflation hedges and defensive plays during uncertainty. Their strength today suggests investors are quietly positioning for turbulence ahead. These rotations don't signal immediate collapse, but they do highlight rising fragility beneath the surface of broad market strength.
Now, let's go back and take a look at a scenario. Now, when a trade becomes crowded, everybody piles into the most leveraged way to trade it generally, and they push it up higher, and it usually is the one that actually stalls out first. So let's take a look at silver monthly chart. This is the 2011 peak, a big rally after the 2008 crisis. We saw a silver sell-off. Doesn't look like much here, but obviously silver had a very big pullback, 60% pullback. Obviously, that is pretty devastating to most people who hold it. People don't realize how much volatility is in silver. But anyway, take a look at what happened in 2011. Silver put in a peak, and that was because everyone piled in and started to play that trade. Whatever's performing best, money naturally gravitates to it. FOMO takes over, and people just have to get into the fastest, shiniest moving thing when it's moving. It's just psychology. It's just trading and the way the charts move. Now let's overlay this with two other charts. Down below here is the gold chart, the monthly, and the gold miners. This is what I've been talking about for a very long time, saying, listen, the best play, well, silver can generate the biggest returns. The most steady play is going to be gold. It generally will move up constantly. You can see here it had a small pause before it started to move up to make all-time highs and keep moving higher, whereas silver made a high back over here, and it didn't perform for several months later. In fact, actually didn't perform for several years later. Look down here, 2008, 2009. So gold is the one that's that steady position. You can continue to pull money out. It's why I like it the most. But now, if you take a look here, gold started trading sideways for a few months right through here, where silver broke out and kept moving higher as the crowded play. Believe it or not, silver topped out 6 months before gold. Gold continued to pause. Silver actually pulled back 12% and put in 6 months earlier before gold actually put in the peak. And that's why I like gold, is because it's that nice steady play. If you're in silver, you do have to know when to pull the trigger and lock in gains and have stops in place, because it will reverse very quickly and change direction. And then on the flip side, during this phase, this is usually when the stock market is actually selling off and money is like piling into the precious metals space. The problem with gold miners is they are a stock stuck in the stock market. And when the stock market tide is going down, it pulls all stocks down, or it naturally is trying to pull them down. So even though money is trying to move into precious metal miners, they barely really budged over the same window. Up about 5%, but more so lots of volatility. A lot of these moves were down 17%, 19%. Over and over again, and if you were lucky, you were able to just etch out a small gain, but you carry tons of risk, 20% downside. And this is why I've been saying this forever, is like, forget the miners, focus on where the safer money is, which to me is gold, or you play silver as more a momentum play and make sure you lock in profits and be ready to sell some. Now, the problem is, and this is where I decouple from most people in the precious metal space, is I can sell precious metals. I can sell any investment. I'm not really that tied to it. I'm in it to make money. I just don't fall in love with the investments like a lot of people do.
Against this backdrop, precious metals have emerged as standout performers. Gold spent years quietly building momentum, drawing institutional interest as a store of value. Now, attention has shifted towards silver, which historically outperforms during late-cycle expansions. Silver's breakout reflects classic market psychology. Once the safer trade becomes crowded, capital chases higher beta alternatives. Meanwhile, gold has paused, consolidating gains while silver accelerates. This divergence is not a sign of weakness. It's often a hallmark of mature bull phases in metals, where leadership rotates before broader volatility unfolds.
And just a reminder, it's been on my mind here, 43.8% of you that watch my analysis here haven't yet subscribed to my channel. So if I could ask you a favor, to help out. If you like the content I share and you want to support the channel for free, a simple way to do this is to just hit the subscribe button and follow what we do and what I share here. My commitment to you is to try to put out more content that's educational, that's actionable. I do read your feedback and I share topics, and I'll cover more topics from what you guys want me to share and teach in these videos. So please subscribe if you like what I do here and share it. And thanks so much. There is a time eventually when things sell off. Keep in mind, last time we saw this happen, silver pulled back, 72%, gold pulled back. If I get this tool here, gold pulled back about 45%. I mean, if you could avoid those and then buy it cheaper later, and during all of these years while it's going down, you could invest in something that's making you a fortune, potentially real estate, something with dividends, the stock market, whatever it might be. You don't have to hold this stuff. So this is a good example of how miners carry a lot of downside risk, very little upside potential. I still think there's some upside, but again, you're weighing it out here. You're going to be fighting a falling tide when the stock market rolls over. Gold naturally trades sideways or higher until the capitulation, and silver will usually capitulate a little bit earlier. And that is the crowded FOMO trade of people chasing it. That's the psychology, the euphoric phase, which if we go back and look at this chart right here, silver gets this euphoric phase first, and people also pile into miners, except for miners don't really go full on parabolic in this particular market environment. And so people moving into miners feel like, what the heck? Why aren't they moving when silver's ripping and gold's, moving higher? And that's simply because the stock market eventually will be pulling down on the miners. And that's why you want to trade the physical metal, because they're not part of the stock market. They can keep moving up. So that is the big picture in terms of what's going on there. Now, if we take a look at seasonality for gold, and this is pretty much the same for silver, we're going to likely see them try to move higher into the end of the year. And so their seasonality is on our side from that regard. So that's kind of the big picture of what I see going on in the precious metal space. Miners, I'd be aware, I'd be a little leery of. Silver has got potential for some more explosive upside, which I'm going to share my targets. And gold, to me, is kind of the safer play, and I think it has higher probability of being able to make money and lock in profits, because silver can reverse on a dime, and it can drop very quickly, 35% in a month, in a couple weeks when we get into this phase. And if you're not finger on the trigger and you don't actually have a strategy to know when to pull the trigger to lock in profits and get out of a trade, then you're going to get back a big chunk of this move. Probably that's unfortunate for most people. All right, so let's quickly touch base on gold on the daily chart, silver, and some targets for both of those. Now, we saw on Friday, if we look at the 10-minute chart, we see gold. There was some big volume, and there was a fairly decent intraday pullback. Now, for gold, it's a pretty big pullback for gold. It's 2 1/3%. For gold, that is pretty big, but we are in a market environment where that is actually kind of a move that we should somewhat be prepared for. Gold is going to have moves of 2+% to the upside and to the downside, kind of, I think, over and over again, because we're in a high volatility state. So this 2% pullback, there was a lot of people freaking out and panicking, and some people being ignorantly rude, all because gold is pulling back. It's unbelievable how a one-day little pullback that is in the norm will throw people for a loop and make them go AWOL.
History offers a cautionary guide. During previous bull markets, silver frequently surged first and peaked first. Its volatility attracts momentum traders, but reversals can be swift and severe. Gold, by contrast, tends to move more steadily, often peaking months after silver. Mining stocks add another layer of complexity. Despite rising metal prices, miners remain equities, vulnerable to stock market drawdowns. When broader markets weaken, miners often struggle, even as physical metals hold value. This distinction explains why disciplined investors treat silver tactically, gold strategically, and miners selectively.
So when we look at the daily chart, what do we see? Gold is in an uptrend. Gold had a little push up right up into resistance, and then some selling came in. Now, there is actually a bigger reason why. There's two reasons why there is selling that hit the market. First of all, gold pulled into resistance, and there's naturally going to be sellers up there. But the main core reason, and this is our partner Brian Benson, who runs our options service, Shared this as well on Friday, saying, listen, the CME, the Chicago Mercantile Exchange, raised the margin requirements for silver. And that's what happens when something becomes volatile and moves fast in the futures market, and everybody starts chasing it. The markets, there's people saying, they think it's a conspiracy and there's all this manipulation. Well, the reality, the big pullback in silver and gold was simply the CME is starting to put some protections saying you need to have a higher margin level because people are starting to get involved and they're starting to bet a lot of money, and they're going to get hurt when silver backfires. So they're saying making sure they have more margin. And a lot of people always trade right to their margin limits. And so if the margins go up, people have to start selling off positions to raise cash to cover the margin requirements in their account. So that's what happened in the precious metal space. We saw margin that kick into place. So that naturally people were selling gold probably to raise cash. They're also selling silver. We saw silver down like 4%, which when you look at the silver chart here, this red bar and all of these other red bars and pullbacks, it's a normal bar. It's normal volatility within the standard deviation of what's been going on recently. So it's not a significant pullback, but there was obviously some heavy selling if we zoom in on the silver chart because people had to sell because of margin requirements. So this might carry over a little bit into next week, Monday. Silver is a fast-moving volatile asset, which means there's more emotions, which means people naturally make more emotional decisions. We could see another big leg down and really shake things up in silver, but overall the margin requirement is kicking in and just forcing people to liquidate. Even if they love silver and don't want to sell it, they have to. Now, another way to look at silver as well is using our Fibonacci tools here. We can just look at the price ranges of what's going on. So if we just take a look at the low that it recently put in and we go up to this high and down to this low, oops, let me get that tool. So let's just grab this tool here. We've got this rally up, we got this bull flag, and it came down to this low. You can see we've got this move up. We got the bull flag and the pullback. We hit the 618. And as you guys know, if we hit the 618 and have some type of pullback, usually we're going to go up and hit that 100% measured move, which is 68.50. This is what we've talked about for about a week and a half. That's the next upside target for silver. And so not only is price moving like it should, and a lot of times, we always project forward where these turning points are, and the market makes these turning points, and it also coincides when pieces of news come out. It's just the way the universe and the markets move. But anyway, we've seen this. We hit the target, we've pulled back with a pause, and now we could see this go up and hit the 68.50, which is a pretty decent move from here. It's a 10% move that could happen in 2 or 3 trading sessions with silver moving to the upside. So anyways, that's kind of where we are. The next targets for me for silver are 68 and then $72. If we were to go and look at 72 will be about a 16% move from where we are. And those are the targets for that. Now for gold, I have the target of about 5,100, 5,200, which I can pull gold up here. If we just zoom back to this recent price action, we can project forward where the run in gold should be. And this isn't any new news. We've talked about this for the last month and a half, that we are looking for about $5,100, $5,200 per ounce. Now, if we do come up here and eventually it blows off and has some peak and the stock market starts to peak, the big picture analysis shows that we could be having a big 30+% pullback eventually in gold. After that pullback, based on Fibonacci retracement levels where we've seen it pull back in the past, it is pointing about $7,400 per ounce for gold down the road. Now that would obviously be after we see this blow off move, and then we see a big correction of 30 or so percent to the downside. And then from there, if we were to just zoom out on this chart, let me just squish this chart down a bit.
Recent pullbacks in gold and silver were not panic-driven collapses, but mechanical reactions to rising volatility. As futures markets heat up, exchanges raise margin requirements, forcing leveraged traders to sell. This often creates sharp, emotional drops that feel alarming but fit historical norms. From a technical perspective, silver remains within a powerful uptrend, with momentum-driven targets still ahead. Gold continues to trade constructively, with room for further advances before any meaningful correction. Volatility is not a warning by itself. It's a defining feature of late-cycle markets.
That would be a pullback to around the 0.38 or 50% correction area, and then rally all the way up to about 7,500 per ounce. So there's some pretty good upside potential here, still in the precious metals space in the near term. Let's just zoom in on gold on the near term here. If we take a look at gold moving to this $5,200 target, we still have about a 20% move in gold. And then from there, we could see it probably have some blow off phase. It might shoot past that temporarily, and then we recalculate the retracement using a Fibonacci retracement level and then go from there. So anyways, overall, the precious metal space is in this very unique time. It is definitely the hot commodity. I think gold and silver are the best play of them, where miners could run into a wall and really struggle to move higher going forward in this phase. All right, so let's pivot and take a look at the stock indices themselves. Now, we had a pretty good pullback on Friday, which triggered quite a bit of selling and fear. We saw elevated volume. Now, there's, I think, a few reasons for that. First of all, the market is right up testing resistance. There's been a lot of news. We had the Fed come out, then we had Oracle, then we had Broadcom, and it's just price is, it's had a very strong pop here, and it's kind of just been trading sideways or kind of grinding a little bit higher, and it hasn't had that correction. And we talked about this, I think it was like on Monday of last week, saying we need to see, if we come down to these 30-minute charts, we need to see like these pivot lows. We need to see all of these little minor pivot lows get run and triggered, meaning we need a pullback, and that will create some panic selling. That'll create an oversold condition, and we should see the market then want to go higher. So there's a lot of people moving in, and now it needs to shake things up. And so we started to see that on the S&P 500. We saw the market dip into oversold territory. I wouldn't be surprised if it wants to dip a little bit more come Monday. We could see some more selling and fear, and hopefully we see the panic selling indicator spike and the VIX spike and people bail out, and then the market wants to go higher. And so that will run a lot of these stops. Now the QQQ is even cleaner on kind of how that's been moving. We started to break all of these. I'll just draw a little horizontal line on all of these minor new lows. The market is slowly trying to pierce all of these lows here. And each one of these is going to have people with a stop in place. They're like, oh, if it breaks this one, I'm getting out. If it breaks this one, I'm getting out. They'll have stop orders triggered. And so the market naturally wants to run. If there's a whole bunch of them layered in here, it's going to try and run them. And if they're close enough together, one triggers enough selling that'll push price down to trigger the next one. And it just turns into a huge, heavy volume waterfall sell-off. And it runs the stops. Everybody gets flushed out on the same pullback. And so we're in this oversold condition, still within an uptrend. And if we look at the QQQ, just look what happens in an uptrend. What happens in an uptrend in a bullish phase? The market tries to buck people out with very sharp drops. Sometimes they're a big one-day drop. Sometimes they take 2 or 3 days. We have another one over here. So none of this is out of the norm, but people really started to get fearful on Friday. But this is something we talked about like 4 days in advance, that if the market does run this, and we talked about how the market could pull back about 1.8%, I think is what we were talking about a 1.8% pullback from wherever the price was when we were talking about it. And of course, that is where it finished the week. So this fear from Friday might carry over and create a gap down on Monday. We see some selling in the morning. You might feel panicky and worried. There's nothing we can do about it, and it might not be a bad thing. In fact, if the market gaps lower and people dump their shares at the open, we could start to see this market rebound, and this could be the flush out, right? Friday and Monday. And then we see the market rip higher. As you can see here, 2 down days, and then boom, the market hits all-time highs. It has 1 down day, and within a week and a half or so, it's at all-time highs again. That's what the market does. It tries to buck you off with a big move that feels manipulated or fearful or all of that.
Equity markets are now displaying classic bull market behavior. Sudden drops designed to shake out weak hands, followed by sharp rebounds. These sell-offs often feel chaotic, but they are common in aging uptrends. Stops are triggered, fear spikes, and liquidity clears, setting the stage for another advance. Whether this leads to new highs or a broader transition depends on timing, policy, and sentiment. What's clear is that selectivity matters more than ever. In this environment, disciplined positioning, not blind optimism, defines success as markets approach their next major inflection point.